we are going to talk about the significance of this upcoming week. As you guys know, you're kicking off full steam ahead in earnings season. And ultimately, where the markets go, whether it is up or down, does influence AMC. What we have seen recently is when there is more red in the markets, AMC tends to rally. And on days where the markets rally, AMC tends to fall apart towards the end of the day. More specifically, you could say this is algos, market makers, hedge funds. I would say it's probably a lot of all of that, but there has been a negative correlation recently, more than not, with AMC in the broad market. So we're going to specifically look at earnings, which earnings are important, which ones you need to watch for on what days, talk about economic data, but there's really a lack of economic data. But we're coming off of some pretty bad news from last week that will have a role to play in this upcoming week. So we got a lot to talk about. Ladies and gentlemen, welcome back to the channel. If this is your first time here and you like to make money, you like AMC stock, you like growing your knowledge base, you want financial freedom, well, hit that like button and subscribe to the channel for the free price of $3.99. Also, if you guys want to come trade with me live in real time, link down below in the description of this video as well. Earnings season is always the most exciting season where you could turn a little bit to potentially a lot of it with just a few trades. Now, none of that is obviously a recommendation. Results are not guaranteed, blah, blah, blah. You guys know the spiel. Simply can be used as a tool to help you in your trading strategies. Now, let's talk about what we have in store for this week. Now, before we do that, I want to touch on the one big thing from last week. And there was a lot of things that happened, right? You had a ton of economic data. Literally a ton. If there was a piece of economic data, you got it last week. And the two things that stand out to me about all of last week is one, core inflation is now higher than headline inflation. And that has not happened since January of 2021, when core was at 1.6% and headline was at 1.4%. Notice where they were, well below 2%. Wasn't even inflation was not even an issue then. At least, you know, in current times, you really didn't even think about inflation. Some people were ringing the warning bells saying inflation will be a problem, but we weren't there yet. Now you actually seen headline inflation fall a lot, but core actually reaccelerate. And core came in at 5.6% year over year, at a 0.4% increase month over month. Headline inflation came in at a 0.1% increase month over month and 5% year over year. A 0.1% increase month over month on an annualized basis is 1.4% inflation. That would be the implied 1 year inflation, you know, from here looking out with headline CPI. Now, core CPI came in at 0.4% month over month. On an annualized basis, that is 4.8% inflation. That is over 100% higher than where the Fed's 2% inflation target is. So a lot of people are starting to say and really question, is inflation actually coming down, or is it just food and energy that is coming down that is making it look like inflation is coming down? And a lot of your major banks, even last week, Morgan Stanley, JP Morgan, they are starting to expect inflation to be very sticky around 4%. And that's far too high. That's where you have a problem, because the markets have been baking in this extended valuation at 18.5 times earnings at $220 of EPS for the S&P 500 based off of Fed cuts. And the markets are expecting Fed cuts. Now, the only way, and I mean the only way, the Fed cuts rates in 2023 is if the economy goes down the toilet. Like, there's no other way to put it. You probably wouldn't want to own a lot of stocks if the Fed cuts rates in 2023. Not to mean that, you know, the markets have to crash when the Fed cuts rates. Usually that's how it goes. Doesn't have to be that way. But if they cut in 2023, it's not going to be good. So wait a minute. Markets are pricing stocks with this valuation that is very much unsustainable, that all has to do with price cuts. Well, the inflation report does not, rate cuts, I mean. The inflation report last week does not support rate cuts, but what is, in my opinion, more important is the data that we got on Friday from the Michigan Consumer Sentiment Survey. You were expecting 3.6% one-year inflation expectations. It came in at 4.6% inflation expectations for the 1 year ahead period. Now, if you look at this on a chart with a line graph here, for the past 5 years, inflation expectations, I mean, this is a massive jump. You've been falling ever since about mid 2022. You've seen slight bumps here and there, but on an overall downtrend since mid 2022 when the Fed started to raise rates. Now you just shot way up, and a lot of people are scratching their heads trying to figure out why this happened. Maybe it was the OPEC cuts to oil. Maybe that did it. But this is consumer inflation expectations, not Wall Street inflation expectations. So this tends to directly correlate to inflation, right? Just think about it. Think common sense here. From 2020, the crash right here, inflation expectations pretty much only went higher. And what happened? Inflation went higher. And specifically towards the end of 2021, when inflation started to ramp up a couple months later, I mean, this was inflation expectations right here, just skyrocketing. Well, it's starting to skyrocket again. And fun fact here, this, where inflation expectations were falling quite a bit, and then you got your first bigger increase, which was, I mean, 3 times smaller than the increase we just got. About a 0.3% increase. Inflation expectations right here in September were at, I believe, if my memory is correct, at 4.9%. And 1 month later, they went to 5.2%, I believe, or 4.7% to 5% was the inflation expectation jump right here. So a third of a percent. This was a whole percent jump. And what actually happened right here? The markets hit a new low. This was the low in October. And I would say part of it has to do with inflation expectations falling for a while and then getting a sharp increase. Well, that has just happened, but on a much larger magnitude last week. So that also does not support rate cuts. Now, the most bullish thing you could say for this market is that over the last month, the expectations for earnings have fallen about 6%. So people are really expecting bad earnings on the S&P 500. Like, that's almost a given right now. So when bad numbers come out, it's not like it's going to be a huge shocker. Now, if numbers are worse than those bad expectations, well, you got a problem, right? So if companies still miss on earnings, it's not going to be pretty. But expectations are lower. Now, I guess the question you should have is what changes the market's mind that the Fed will cut rates in 2023? Well, a lot of people were hanging their hats on the banking crisis. Well, we just had bank earnings on Friday, and JP Morgan rallied 7.5%. Citi rallied 5%. Bank of America rallied 4%. Just as an example here. Doesn't look like the banking crisis supports the Fed cutting rates. Nothing really supports the Fed cutting rates. Nothing points to rate cuts coming. So pretty shortly here, you're going to see the markets turn their opinions on that. And I think it's going to be sharp and it's going to be drastic. And that's really the one thing that's going to bring this market down. Comes down to earnings or the Fed rate cuts ultimately getting priced out of the markets. That's what could send you down to those lows in October. Now, if we take a look at the earnings that we have for this week, now this is going to be the start of earnings season. You're going to get into the thick of it pretty quickly here by Tuesday. You're going to have some pretty big companies reporting earnings, but even more so important than this week is going to be next week. But I think if these earnings are bad, You're probably gonna get a lot of that sell off or run up heading into your Apple, your Amazon, your Google earnings next week. You'll probably either feel the pain or the red or the green, to put this in simpler terms, this week heading into those big earnings next week. Like if Netflix is bad Tuesday and after hours, it's probably going to immediately affect all of your large technology companies. And you're probably going to start to see some of that pain in the broad markets. Now, let's not get too far ahead of ourselves. Monday morning, so tomorrow morning, Charles Schwab, M&T Bank, State Street, and Quaranty Bank and Trust. So some more banks that report Monday pre-market, and that's basically the story of Monday after hours as well. Couple smaller banks that will report earnings. Now Tuesday morning, Bank of America, and I think the bank earnings, obviously they're going to be pretty good across the board, a lot better than what they could have been. So I don't really expect the banks to fall too much from here unless new information does come out. But again, it's supporting the Fed not cutting rates in 2023. The better bank earnings are. In a weird way, the best case scenario here would be the banks that we reported on last week, JP Morgan, your Citi, your Wells Fargo, they had pretty good earnings. In a weird way, your best case scenario would be Bank of America having bad earnings, Charles Schwab having bad earnings, M&T Bank, bad earnings, State Street, bad earnings, Quaranty Bank and Trust, bad earnings, BNY Mellon, bad earnings, Goldman Sachs, bad earnings. That might start to support a Fed rate cut more than good earnings. Now, you'll also have Johnson & Johnson. Don't expect that to be a huge deal because, I mean, it's a pretty stable company overall. Tuesday, after hours, you're going to get Netflix. You're going to get, looks like Martin. You're going to get Western Alliance Bank Corporation, Intuitive Surgical, and some smaller banks as well. Netflix, do we have to elaborate on this? Probably not, but we will. It'll be huge for the markets, for technology in general, how the appetite is of consumers to actually spend money on entertainment. Because, I mean, Netflix has been raising prices for a while now. Are consumers starting to not want to pay Netflix pricing? That's going to be big because it has implications for iPhones. It has implications for advertisers, and so on and so forth, that really comprise your large technology companies. Now, Wednesday pre-market, Morgan Stanley, U.S. Bancorp, Abbott, NASDAQ, and Ally Citizens Financial Group. Banks, they will be important, but until we get new information, I don't really expect a whole lot. We already know bank earnings are going to be pretty good because of the bank earnings we had last week, so I don't think they're going to be as important. Now, what will be important is Tesla, Wednesday and after hours. Biggest thing here, margins. If margins start to get squeezed at Tesla, it's probably going to happen at other companies as well, and that's not good for the value proposition of our markets. IBM, again, another one of those stable, more stable kind of companies, been around forever, doesn't really see too much growth, doesn't really see a whole lot of declining growth, kind of that midway kind of company, don't expect a whole lot. Alcoa, that one could be interesting. But really, Tesla and Discover. Discover will be big. It will give you insight into the state of the consumer. Might start to see defaults tick up a little bit. That's really what I want to know, is are people starting to default on some of those credit card bills, and how is credit card utilization overall? Might tell you a lot. Now, Thursday, pre-market, you have TSMC. We got some pretty bad news out of them recently, so I think that's kind of priced in already. American Express as well, Thursday pre-market. That'll be big for the same reasons it's big for Discover. Alaska Airlines, again, think sectors here, right? Banking sector will be big this week. Pharmaceuticals, healthcare with Johnson & Johnson, Rite Aid, right? HCA Health, SAP, that's more insurance along that line. Right, your certain sectors, Discover, American Express, they're going to affect financials and really consumer lending. Think like buy now, pay later, like Affirm. I was trying to, own them from a while back. There's huge loss in the portfolio. But nonetheless, think of those companies, right? The SoFi could be affected by some numbers from Discover or American Express as well. Healthcare, like I said, banks, but also technology with Netflix, Tesla, and TSMC. So that's what you have this week as far as earnings. That's going to be the big story. You really don't have anything for economic data, so it's not much use to comb over that. Couple Fed speakers here and there. I highly recommend you guys just go to Trading Economics and click on the calendar. You'll get a rundown of, you know, everything. And if you want to look at like inflation expectations for, you know, history, you can pull that up. You can pull these charts most of the time out to a 25-year chart. And I mean, even if you look at this on a 25-year chart, not too often do you see inflation expectations go up this much. This much. I mean, just a select few moments in time has this really happened, and it's usually before crises happen. And you could say that happened in 2021, before the crisis, multi-year flat market that we've seen since 2021, right? So long story short, not good, potentially. I mean, earnings are going to be the big story this week, and that's going to get pretty interesting. Now, futures right now, NASDAQ up 0.13%, S&P up 0.20%, and the Dow up 0.16%. But look who we got. Janet Yellen says U.S. banks may tighten lending and negate need for more Fed rate hikes. Isn't that rosy? Quote, banks are likely to become somewhat more cautious in this environment, Yellen said in the interview, which is scheduled to air on Sunday. Quote, we already saw some tightening of lending standards in the banking system prior to that episode, and now there may be some more to come. And this is obvious. I don't think the markets are really going to care about this all too much. The markets are already pricing in less Fed, rate cuts based off of this. I'm not convinced Janet Yellen knows the first thing she's doing right now. So, I mean, I don't think it's going to affect the markets all too much. But nonetheless, it's a possibility, so I wanted to put it here in this video. Now, as far as kind of markets on a more technical basis and AMC as well, like I said, the two have a really negative beta as of recently. When the markets go higher, AMC tends to go lower. When AMC goes higher, markets tend to go lower. And that's consistently kind of what you've seen, even on some specific like 1 minute candles. If the markets sell off big, AMC usually rallies or usually gets a little popper right throughout the day. And I don't think that to be any different this time around. Now, Carter Worth over on CNBC, he's the chart master. I think he put it pretty well that there's not really a bullish catalyst from here to make stocks go higher. You're already expecting massive Fed rate cuts. You're expecting bad earnings. There's probably not going to be better earnings. There's probably not going to be more multiple expansion from here because you're already in a very richly valued market. So what is there from here to make the markets go higher? Not a whole lot. Not a whole lot at all. So I think that sets you up for potentially a move back under that $400 level on the SPY. Could happen this week. Would not surprise me because after all, out of the last 5 weeks, the Dow has been up 4 of them and returned another 1% last week. It's been a basically continuous bull here, and I'm not going to argue with it because I have a long-term portfolio as well, but it's really far overdone for the current state of our markets. But a 4.5% drop from here would put you back at 393 on the S&P 500, and I think that is possible to happen this week, especially once you get Netflix and Tesla earnings as well as Discover and American Express. That's kind of what I'm forecasting, guys. That is going to do it for this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Like I said, if you guys also want to trade with me live in real time, link down below in the description of this video as well. Thank you guys for watching, and I will see you in the next one.